My dear students, welcome back to our channel. In this video, I will be explaining the MBA second semester subject Financial Management as prescribed by JNTU and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 3 first important short question is: distinguish between capital structure and financial structure. Capital structure versus financial structure. In simple words, both capital structure and financial structure talk about how a company arranges money for its business, but there is a small difference. Capital structure means the mix of long-term sources of finance such as equity shares, preference shares, debentures, and long-term loans. It focuses only on permanent capital used for growth. Financial structure is a broader term. It includes all sources of finance, both long-term and short-term, such as equity, preference shares, debentures, loans, trade credit, and even bills payable. So, capital structure is a part of financial structure. Example, suppose a company has equity is equal to 5 lakhs rupees. Debentures is equal to 3 lakhs rupees. Bank loan, short term, is equal to 2 lakhs rupees. Here, capital structure is equal to 8 lakhs rupees, equity plus debentures. And financial structure is equal to 10 lakhs rupees, equity plus debentures plus loan. In short, capital structure is equal to long-term funds, while financial structure is equal to all funds. Next important short question is: 2. What is the indifference point in financial leverage? Indifference point in financial leverage. The indifference point is the level of earnings before interest and taxes, EBIT, at which a company is indifferent, neutral, between two financing options, like equity or debt. At this point, the earnings per share, EPS, remains the same, no matter which source of finance is chosen. In simple words, it shows the break-even EBIT where the benefit of debt, like tax savings, and the burden of interest cancel each other out. If EBIT is below the indifference point, equity financing is better because debt interest becomes a burden. If EBIT is above the indifference point, debt financing is better because leverage increases returns to shareholders. Example: suppose a company can raise funds either by equity or by debentures with fixed interest. If the EBIT is 2 lakhs rupees, EPS under both methods comes out equal. This is the indifference point. In short, indifference point helps management decide the best financing option depending on expected profits. Next important short question is: 3. Break-even analysis of financial leverage. Break-even analysis of financial leverage is used to find the level of earnings before interest and taxes, EBIT, at which a company's earnings per share, EPS, under different financing plans become equal. This is also called the financial break-even point or indifference point. In simple words, it shows when using debt, borrowed money, and using equity, shares, will give the same return to shareholders. Beyond this point, if EBIT increases, using debt is more profitable because of the advantage of leverage. But if EBIT falls below this point, debt becomes risky due to fixed interest costs. Formula: financial break-even EBIT is equal to interest plus preference dividend divided by 1 tax rate. Example: if a company has to pay 40,000 rupees as interest and the tax rate is 30%, then break-even EBIT is equal to 40,000 divided by 0.3 is equal to 57,143 rupees. So, only when EBIT crosses 57,143 rupees, shareholders benefit from debt financing. In short, Break-even analysis helps companies decide the safe level of debt in their capital structure. Next, Unit 3. Long questions. First important long question is: explain the different types of leverage, operating, financial and composite, with examples. Different types of leverage in financial management. Leverage means using fixed costs to increase the return for owners. It helps us understand how changes in sales or profits affect shareholders. There are mainly three types: operating leverage, financial leverage, and composite leverage. 1. Operating leverage, OL. Operating leverage happens due to fixed operating costs like rent, salaries, or depreciation. If a company has high fixed costs, even a small rise in sales will bring a big rise in operating profit, EBIT. Example: a factory pays 50,000 rupee rent per month. Whether it produces 100 units or 500 units, the rent is the same. So, more sales bring more profits once fixed costs are covered. 2. Financial leverage, FL. Financial leverage comes from fixed financial costs like interest on loans or preference dividends. If EBIT is high, debt increases return for equity shareholders, EPS. But if EBIT is low, debt becomes risky. Example: a company borrows 5 lakhs rupees at 10% interest. If EBIT is large, interest is easily paid and extra profit goes to shareholders. If EBIT falls, interest burden reduces profit, making it risky. 3. Composite, combined leverage, CL. Composite leverage is the effect of both operating and financial leverage together. It shows how a change in sales will affect the earnings per share, EPS. Example: if sales increase by 10% and due to operating plus financial leverage, EPS increases by 30%, then the company has high composite leverage. Summary: operating leverage, business risk from fixed operating costs. Financial leverage, financial risk from debt interest. Composite leverage, total risk, effect of both. In simple words, leverage is like a double-edged sword. It can boost profits when business is good but also increase losses when business is bad. Smart companies balance both to maximize shareholder wealth. Next important long question is: 2. What is EBIT-EPS analysis? How is it useful in capital structure decisions? EBIT-EPS analysis in capital structure decisions. 1. Meaning: EBIT-EPS analysis is a tool used in capital structure decisions. It helps managers decide whether the company should raise funds through equity shares, ownership, or debt, loans. EBIT is equal to earnings before interest and taxes, operating profit. EPS is equal to earnings per share, profit available for shareholders per share. This analysis studies the effect of different financing options, equity versus debt, on the EPS at different levels of EBIT. 2. How it works. Companies can finance expansion by issuing equity, no fixed cost, but profit is shared among more shareholders, EPS may reduce. Raising debt, fixed cost in the form of interest, but if EBIT is high, EPS increases as fewer shareholders share profit. Thus, EBIT-EPS analysis shows at what level of EBIT debt financing is better and when equity financing is safer. 3. Example: suppose a company needs 10 lakhs rupees. Option A: issue 1 lakh equity shares of 10 rupees each. Option B: issue 50,000 shares plus take 5 lakhs rupee loan at 10% interest. If EBIT is equal to 2 lakhs rupees. Under equity option, no interest is paid, EPS is equal to profit 1 lakh shares. Under debt option, interest is equal to 50,000 rupees net profit divided among only 50,000 shares, EPS is higher. But if EBIT falls below a certain point, debt becomes risky because fixed interest must be paid. 4. Usefulness in capital structure. Helps in deciding the best financing mix. Shows the indifference point, where EPS is same under both options. Helps balance risk and return. Guides companies to choose debt in boom periods, high EBIT, and equity in uncertain times, low EBIT. In short, EBIT-EPS analysis is like a profit calculator that shows which financing option gives better shareholder returns at different profit levels. It helps companies avoid unnecessary risk and select the most profitable and safe capital structure. Next important long question is: 3. Explain the concept of capitalization. What are its types and problems of over and under capitalization? Concept of capitalization. 1. Meaning. In financial management, capitalization means the total amount of long-term funds used by a company. This includes share capital, reserves, and long-term debt. In simple words, it is the total investment made in a business for its growth and operations. Example, if a company raises 20 lakh rupees through equity and 10 lakh rupees through debentures, its capitalization is equal to 30 lakh rupees. 2. Types of capitalization. 1. Proper capitalization, when the company has just the right amount of capital, neither too much nor too little. Business runs smoothly, and investors earn a fair return. 2. Overcapitalization, when a company raises more capital than required. As a result, profits per share become low, dividends reduce, and share prices fall. Example, a company worth 50 lakh rupees issues shares worth 80 lakh rupees. Its earnings will look small compared to capital, leading to unhappy investors. 3. Undercapitalization, when a company raises less capital than required. Here, profits per share appear very high, dividends are large, and share prices rise unnaturally. Example, a business needing 1 crore rupees works with only 50 lakh rupees capital. Earnings look higher, but the company struggles with expansion and overwork. 3. Problems of overcapitalization. Low dividends, loss of investor confidence. Decline in market value of shares. Difficulty in raising funds in future. Poor reputation of the company. 4. Problems of undercapitalization. Very high dividends may look attractive, but they create suspicion among investors and government. Employees may demand higher wages seeing high profits. Management may misuse excess profits. Company may fail to expand due to lack of actual funds. In short, capitalization is the foundation of financial planning. A balance is necessary. If there is overcapitalization, the company suffers from low returns. If there is undercapitalization, it creates tension and unfair expectations. Proper capitalization ensures stability, growth, and investor trust. Next important long question is: 4. Discuss in detail the capital structure theories, NOI and traditional approach. Capital structure theories, NOI and traditional approach. 1. Meaning of capital structure. Capital structure refers to the mix of debt, loans, and equity, shares, used by a company to finance its business. Theories of capital structure try to explain whether the choice of debt and equity affects the value of the firm and its cost of capital. A. Net income approach. This theory says, more debt is equal to better value of the firm. Reason: debt is cheaper than equity because interest is tax deductible. So, by increasing debt, overall cost of capital decreases and firm value increases. Example, if a company earns 10 lakh rupees and it finances more with debt at 10% instead of costly equity, its overall return for shareholders rises. Conclusion: NI approach supports maximum use of debt. B. Net operating income (NOI) approach. This theory is opposite to NI. It says, capital structure does not matter. Value of the firm depends only on its operating income, EBIT, and not on whether funds come from debt or equity. The weighted average cost of capital, WACC, remains constant at all levels of debt. Example, whether a business uses 100% equity or 50% debt plus 50% equity, as long as EBIT is 20 lakh rupees, the firm's value remains the same. Conclusion: debt does not affect firm value. C. Traditional approach. This approach is a middle path between NI and NOI. It says, using debt up to a certain limit reduces cost of capital and increases firm value, like NI. But after a point, too much debt increases risk and cost of equity, which raises overall cost, like NOI. Example, a company may benefit from 40% debt in its structure, but if it takes 90% debt, shareholders will demand very high returns due to risk. Conclusion: optimum capital structure exists. A balance of debt and equity gives maximum firm value. In short, NI approach, more debt is equal to higher firm value. NOI approach, capital structure doesn't matter. Traditional approach, best results come with a balanced, optimum mix of debt and equity. Next important long question is 5. Explain the Modigliani-Miller theory of capital structure. What are its assumptions and criticisms? Modigliani-Miller theory of capital structure. The theory, given by Franco Modigliani and Merton Miller, is one of the most important theories in financial management. It explains whether a company's value is affected by its choice of debt and equity mix. 1. Proposition I, no taxes. It says, capital structure does not affect the value of the firm. Whether a company is financed fully by equity or by debt plus equity, its total value remains the same. Reason: investors can create their own leverage by borrowing money themselves, so the firm's leverage gives no extra benefit. Example, if Company A, all equity, and Company B, debt plus equity, both earn 50 lakh rupees EBIT, their total value will be the same in a no-tax world. 2. Proposition 2, cost of equity and leverage. As a company increases debt, the cost of equity increases because shareholders feel more risk. But the overall cost of capital, WACC, remains constant. Example, if a firm takes more loans, interest is fixed but shareholders demand higher returns. Hence, benefits of cheap debt get cancelled out. Assumptions of theory. 1. No taxes, later modified to include corporate taxes. 2. No transaction costs or bankruptcy costs. 3. Investors and companies can borrow at the same rate. 4. Perfect capital markets, everyone has equal information. 5. Business risk remains constant. With taxes. When corporate taxes are included, debt becomes cheaper because interest is tax deductible. Hence, firm value increases with more debt. Criticisms of theory. 1. In real life, there are taxes, bankruptcy costs, and transaction costs. 2. Investors cannot always borrow at the same rate as firms. 3. Too much debt increases financial risk, which affects value. 4. assumption of perfect capital markets is unrealistic. In simple words, without taxes, capital structure doesn't matter. With taxes, debt increases firm value because of the tax shield. But in reality, too much debt is risky, so companies need a balanced capital structure.